Okay, this is the third lecture for Unit 6. We're going to look at some of the concepts that we perhaps didn't spend as much time as we might have in Chapter 5. And I'm going to start with Section 5.3. And I want to make sure that you don't get confused about something. Note that when we're looking at working capital and the current ratio, we're doing financial analysis. We're actually looking at the completed financial statements for the company, and we're analyzing how efficiently they operate and how liquid they are, how many times that they're able to satisfy their current expenses in the current ratio, how much, in a gross sense, they have in working capital, measure of financial strength and liquidity. Note that this kind of financial analysis is different than the troubleshooting mistakes, different than looking for mistakes by troubleshooting, such as when your debits don't equal your credits. When you're out of balance, you find the difference and you look for the difference in your numbers. And if you can't find that, then maybe you divide the difference by 2 to see if you've got a number that you've entered as a debit where it should have been a credit, or vice versa. And then if that doesn't work, then you divide the number by 9 to see if you've got a transposition. And then if those don't work, then you might have to just go back and review each journal entry and T account to find the mistake, or more probably there's 2 or 3 mistakes, which is the reason that the shorthand systems don't work. And so anyhow, troubleshooting is different than financial accounting. I wanted to start with that. Now, the big part of Chapter 5, the payoff for Chapter 5, is that this is the culmination of the first 5 chapters. And so now you can see, we have the dark blue circles for each step in the accounting cycle. And so we go through that where we identify and analyze the transactions. Remember, we did that in Chapter 3. We record the transactions to a journal. We post the journal information to the ledger and prepare the unadjusted trial balance. And that was all work that we did in Chapter 3. And then in Chapter 4, we went through the adjusting entries and prepared the adjusted trial balance, and we prepared financial statements from those adjusted trial balances. And then we do the closing entries at the end of the period, and we do that to prepare the post-closing trial balance to get ready for the next period. And then the 10th step in the process, which, remember, we said we would probably get to in intermediate accounting, not in this course, is to look at possible prior period adjustments and any reversing entries that need to be made. So that's the comprehensive accounting cycle, and it's the process in which transactions are recorded in the accounting records and are ultimately reflected in the ending period balances on the financial statement. And so what they do in this case is we have the example in our materials of the marine barber Cliff, who's going to set up a company called Clip-'em Cliff after he spent 20 years being Semper Fi in the Corps. And it gives you a whole series of transactions, I guess about 11 transactions for Cliff's Barbershop. And I have to tell you, there's a little bit of unrealisticness for this particular example, because one, most beginning barbershops are not this well capitalized. The revenue amounts are rather spectacular for some of the work that he does, but nonetheless, it's a good example to teach from. Don't think that this is a guide to how to, as far as how to set up a business plan to open a barber shop or other small businesses. This is just an example to illustrate accounting transactions. And you can see during the month of August in 2019, there's these various transactions, and it gives you a description of the transaction. So the first one, where Cliff issues $70,000 worth of common stock in exchange for cash. Now, it says $70,000 shares, but that might be 100 shares. I mean, you typically, if it's a new corporation being started and there's one owner, Cliff, and it's just kind of a mom business or a pop business or even a mom and pop business, there's typically a minimum amount of capitalization. So don't get confused if you go into a business planning class. I know that I've seen trained attorneys who start out in business, and if there's $30,000 used to capitalize the business, and if the stock is $1 par value, they issue 30,000 shares at $1 a share, whereas you can always have a number of shares that equal 100% of the stock. That doesn't have to be such an unwieldy amount. And the other thing is that many businesses are set up by beginning attorneys with 100,000 shares of capital stock being authorized, even though only 100 shares or 1,000 shares are ever issued. And so don't make yourself crazy with this. Just more and more practice, become more familiar, get more experienced, and you'll know how to do this. But in the book, it just says that Cliff takes in $70,000 in cash into this business and issues $70,000 worth of common stock. And you see the analysis of transaction number one on the second page of your book, if you've printed it out not landscape, but whatever the other way to print it out is. You can see that the analysis, Cliff, the business, which is Cliff Incorporated, if it's a corporation, or Cliff Corporation, it could be CCC Inc., has cash, has $70,000 cash. They say more cash, since it's the first transaction, maybe more cash is the same as cash. And cash is an asset, and so you're increasing the debit to put cash on the balance sheet, and then you have an offsetting credit entry to common stock, which is the typical, the normal type of entry for an equity account, is to have a credit entry. And so you can see the analysis of an increase in assets by 70,000, nothing in the liabilities column, and then an increase of 70,000 in stockholders' equity. And that's how you journalize and then also account for the transaction, and to show that it is a transaction which was properly recorded and which preserves the accounting equation with our double entry system of bookkeeping. Then you have the second transaction, which is to purchase equipment with $37,500 of that cash, and then also getting credit or a loan. It's a credit to accounts payable for the other $75,000. And so you can see a complex entry here. It's got more than two entries. You have a debit to equipment. Equipment is an asset, and so the $45,000 debit goes to equipment. And then you have two credit entries, $37,500 for the cash that was spent, and then $7,500 to book the accounts payable to the equipment vendor. And so that is your entry for transaction number two. Now you can go transaction by transaction through this if you're having any trouble understanding the analysis and the entry of your transaction. So this is designed to be a review for you of what you learned in chapter 3. So these are the basic transactions that you're going to look at, and you go through the purchase of supplies, the receipt of $4,000 in revenue for one heck of a haircut, and or perhaps haircuts for an entire group of people. And then utility expense. You can see some of these other expenses, and you've got receipt of cash for haircuts to be delivered in the future. That's unearned revenue. And these are all journalizing transactions as they occur. When you get unearned revenue, that's a normal transaction that's journalized in your journal of accounts, because cash is going into your bank account, and then you just you book the unearned revenue as a liability account, because you've received cash for services you haven't performed yet. And he pays a dividend, and that shows up in the regular journal as well. And it's a cash transaction. If you buy things like the equipment on credit, if it had been all for credit, you would still journalize that too, because you got the equipment, you have a source transaction document, you have a purchase order or a receipt, and you book that, and you book the asset that you've acquired, and then book the offsetting liability, even if you haven't paid for it in cash. That's what we do with accrual accounting. And so you can see the journal that you end up with with these 11 transactions for the month of August, and all your debits equal your credits, and you get to the end of the month and you have all these nice T accounts, and you can see the T accounts that you have about halfway through this section. Now then this takes you through the preparation of the unadjusted trial balance, and you can see how you transfer the T accounts. So you're taking your T accounts and you're transferring all of them to the trial balance, and it just gives you these two examples, but you can see how it's done, and you can certainly compute, you can create the rest of the trial balance, and as you can see, the book has done it for you right here. So you see the unadjusted trial balance that balances at $87,900, and now we go into the adjustment process, and so we start to book the adjustments. And so these are the adjusting entries that you learned in chapter 4, and you can see, well, what's the first one we have? Well, we have depreciation expense. So we've got to go ahead and calculate how much depreciation was used during the period. And so during the period, all that equipment that we purchased, of the $45,000 in equipment we purchased, we're using it at a rate of $2,500 per month. I guess this is a straight line calculation, and so we've got to go ahead and do that adjusting transaction. Oh, and look, we use some supplies too. Wait, I missed the supplies. Where did the supplies go? Oh, the supplies were in the middle of the page. Okay, so first thing we did, the first adjusting transaction we had, is we recognized that we used some of our supplies. So that's on there. Then we have the depreciation expense adjustment. Then we have to calculate the unearned revenue. So we got the $3,200 for haircuts in the future. Well, we did about a third of them almost, and we earned $1,100 in service revenue, and we have to book a debit to unearned revenue, which is we're decreasing the liability because we actually earned the cash, or at least a portion of the cash that we were paid in advance. And then a very common adjusting entry at the end of the period is to calculate interest receivable. We had some asset that was, I guess, a note that was earning interest, and so we book that. And then another expense near and dear to my heart is income tax expense. So we anticipate that based on the income we had for the period and based on the tax rate that we're going to have $3,400 in income taxes based on the earnings for this month. Now, we don't have to pay income taxes every month. We only pay it for a year. So at the end of the month, we would calculate the pro rata amount of income tax we think is associated with the income that we have. And it's we'll probably look at that a little bit later on in the semester, but really the income tax accrual is a really sophisticated technique that when you get into practice, you're going to find that the manager on your account, if you're working for a big accounting firm, is actually going to perform that accrual, and it's going to be reviewed carefully by the partner and signed off on before it goes on to the financial statements. And so that's often the source of some controversy between accountants and the Internal Revenue Service, particularly for audited companies, as why the income tax accruals that were made during the year don't equal the amount of income taxes actually paid at the end of the year, because there's been some good tax planning done. And you can see a summary of your adjustments in the journal entries. You can see those 5 adjusting entries in figure 5.19, and so you can see how those are reflected in the T accounts and the journal. And you can see your adjusted T accounts, and then you have an adjusted trial balance that is presented as figure 522, and that's made from the T accounts as they've been adjusted for the adjusting entries. And now it's time to prepare an income statement from the adjusted entries, and also a statement of retained earnings and a balance sheet. And you can see how those are all prepared. Now, right after that, we get to a new set of journal entries. These are our closing entries for the period. And so we're only going to close the temporary accounts, which are the revenues, the expenses, the income summary, and the dividends. And so you can see those closing entries, which appear right after figure 5.25, the adjusted balance sheet, or the balance sheet prepared after the adjusting entries. And now you can see that we have closing entries for the period, so we're going to offset the revenue accounts and put a credit and income summary. We're going to offset the expense accounts and put a debit in income summary. And we see after all of this, we have $25 left over in income summary. And my immediate reaction to this is that Cliff should get a new tax accountant or advisor, because if he's only got pre-tax income of $3,425 and he's paying $3,400 in income tax, he has an idiot for a tax advisor. But in any event, don't worry about that. This is just an example to show you how to make the entries. And then you close out the income summary account to retained earnings, and you see that you are increasing retained earnings by $25. You also close out the dividends account to retained earnings, reducing retained earnings by the amount of dividends that are paid out. And as you can see, they're paying out more dividends than there are after-tax earnings, which means that there's some other tax issues involved here, which if I ever teach an income tax class here, I will be happy to explain to you. But trust me, this is a very silly example. You then see the balances in all the T accounts for all of these temporary accounts have now been taken to zero, and then you see retained earnings has a debit balance of $125 in it, which means it's negative. Retained earnings are typically a credit if there's positive earnings, but this is an accumulated debit in retained earnings, so more earnings have been distributed than have actually been earned. And you can see that the closing entries are actually numbered, which is a nice accounting technique to actually number your closing entries, number your adjusting entries, so that you have a nice paper trail to follow for whoever is following you. And at this point, you can prepare the post-closing trial balance, which is just basically balance sheet accounts, and you can see that there in figure 5.27, and you have now done the complete accounting cycle. So that's it for Unit 6 as far as the lecture. Good luck on your midterms. Stay up and make sure that you've caught up with your homework. Make sure that you watch the videos, and the next videos that I will be posting will be reviews of the homework and the quizzes for the first 5 chapters that haven't been posted yet. So look at those and then take your midterm and all get straight A's. I want everybody to get 100% on the midterm exam and get the full amount of points that you were entitled to. So good luck, and we'll talk with you again soon. Thanks a lot. Bye-bye.